everyone, let's begin with our portfolio management lesson. Okay, now portfolio management, very interesting and very simple also. Portfolio management is nothing but, say if I tell you that invest in shares. Okay, shares of you can say TCS, any example. Okay, shares, stocks. Okay, you have invested in this particular stock. One share is say for 1500 rupees and you have invested 10 such shares. 15,000 is your investment. Okay, whatever will be the changes in the market, up or down, based on that the stock will also move, and based on that you will always have your returns generated. So this is a very small amount, 15,000, but if I tell you that invest or take, like you have some say 15 lakhs rupees and you want to invest, you want to put this money in the market, invest and get returns. And if I tell you that put all this money in TCS, buy as many shares as you can, so tomorrow if there is a there is good returns generated in this particular organization, this particular sector, you are going to make a lot of money. But what if tomorrow this sector falls? Immediately it crashes. So then what will happen? You will have so much of amount of loss. Okay. So basically your portfolio management is nothing but to have a collection of investments in such a manner. If you are having a good amount of portfolio money, okay, your amount you want to invest, if you are having that invested in such a manner that you can generate highest return with minimum risk, is how it is done the management. So I am my own portfolio manager. Okay, whenever I have some extra additional amount left with me or some amount of portion of cash, I will tell him that okay fine, I want to invest. There will be few questions he will ask. Okay, you want this money back in how many years? Are you in any need of money in another 6 months or 1 year or 2 years? What is the return you are looking at? How much is the risk you are ready to bear? All these questions he will ask me, and accordingly he will take a decision and understand that okay, this we will invest in this amount. Out of 5 lakhs we will put 2 lakhs in this particular mutual fund, some 1 lakh in debt, and the balance 2 lakh is in form of stocks, which is going to give you good return. So he is kind of placing my entire portfolio in such a manner that I will get a good return in an efficient manner with a risk which I am ready to take. It is maximization of the wealth of an investor. At least my principal amount in that manner is hedged. Okay, it is protected. So why? Because if a particular, now if I will tell him that okay, invest in software sectors today, okay fine, software sectors are booming. What tomorrow if it goes down? If entire my money is in that same sector, I will have a downfall in each and every form of investment. So it is necessary to have the placing, okay, or the collection in such a manner it is placed in different sectors. It is also diversified in unrelated type of securities. Okay, the amount is kept in unrelated type of securities. It is also seen that your risk is minimized with your maximum return. Okay, so this is basically your portfolio management. Okay, managing your portfolio in an efficient manner. We are going to do the theory which was given by Markowitz. Okay, so that theory we are going to do it ahead. Objectives of portfolio management, simply this is read. Obviously this is to reduce the risk. There is a safety of principal I just spoke about. Stability of income. Okay, now I have my one particular investment wherein I want a particular income to be flowing in my account monthly. So I have that particular portfolio in that manner. Okay, so there is a stability of income, there is a growth, there is wealth maximization, there is liquidity. Okay, there is a liquidity in the market. It is easily marketable. It can be sold. I can liquidate it and I can have the opportunity of getting my money back and using it in some other type of investments. And it is tax savings also. We do a lot of investment for the purpose of saving our tax. Okay, I generally do that. I invest my additional amount and try to save the tax. So portfolio analysis, if you see this, I will have some amount in real estate, some I will invest in gold, some in the debt of another sector, say into software sector, telecom sector. Okay, I'm into equity of say this travel sector. So this is how my portfolio, and I'm growing my portfolio. I'm getting a lot of returns also. So out of my that 5 lakhs rupees, say my 3 lakhs is into equity and the 2 lakhs I have diversified. Okay, so even in the equity there is lot of diversification which can happen sector wise. Now two objectives are there whenever there is a portfolio management happening. We have to analyze the portfolio. So two factors are considered by any portfolio managers. They are first thing, they're market experts. Okay, they know each and everything. They know about the events which are going to happen. They study that particular stock over a period of time. They also have all the understanding about the mutual funds and everything. So there are two things, there are two objectives in portfolio analysis. One is minimum risk with your maximum returns. This is the entire chapter revolves around these two objectives. Okay, your entire chapter. So individual securities, if you see, have risk return characteristics of your own. So if I talk about a particular security X, it will have its own return, it will have its own risk. But if I am talking about many other different types of securities, there will be an adjusted risk with a greater return. Okay, so portfolio management refers to efficiently management of the investment in the securities by diversifying the investment across the industry lines or the market types. Okay, whichever industry I am interested in, real estate, also infrastructure industry, in your FMG industries, or your telecom industry, software industry, whichever. Okay, investment in companies in dissimilar industries is also very good. Okay, it's likely do much better. Okay, it will give you a better return, unlike industries, because if one particular sector will fall, not necessarily that second sector will fall. Okay, so it is very important to have your portfolio diversified. Okay, now components of risk, we have been studying this time and again. There are two types of risk. One is systematic, which is always there. It is not going to get control. It is existing in the market. Okay, so when I talk about beta, I am talking about systematic risk. It is the risk associated when you start investing your money in market. So the benchmark of Nifty is beta is always 1. We have already done that. Beta is already 1. We use this as a benchmark. So say suppose for Nifty, okay, beta is 1. Okay, and the return, now the Nifty is showing a positive return. Nifty has moved up by 10%. Okay, I have my stocks in Reliance. Okay, this is moved up by 20%. Nifty is moved up by 10%. Reliance is giving me a return by 20%. So if I want to know the beta of Reliance, it will be 2. Simple. Why? Because Nifty's benchmark they have already put, it is 1. Everything else we will revolve it around and adjust it with this Nifty's beta, because it is the systematic risk. Higher the return, higher the risk. Okay. So components of risk we know. Now measurement of the risk. We measure the risk by standard deviation. We have done it in the sums of portfolio management. So the greater the deviation, okay, if the value of dispersion is more, then higher the risk. Okay, so if you are saying that, oh my god, with there is in due to a particular event in an organization where you have invested money, there is a return of 18%. Okay, there is a return of 18%. Good rate of return has been given. Okay, rate of return. But their deviation, they are going to deviate. If anything tomorrow goes up and down, the return is going to deviate by 2, by say, this return may go up or fall by say 10%. The deviation is 10. So if it is a boom period, it is going to go up by 10, but if it is a falling period, you are going to make a loss also of 10%. So the greater the deviation will be, higher the risk of the portfolio. So deviation is nothing but the average of your your average of your deviations, the mean of your deviations. Okay, standard deviation formula. Don't do this particular formula, we have already been solving the sums, okay, of standard deviation. So standard deviation of a portfolio, it is the risk of a portfolio is not equal to the sum of its parts. Okay, so if I am telling you that in my portfolio there are 5 types of securities, 5 different types of securities, different investments I have done. So your risk portfolio will not be as the same of each security's risk. It will be different. It will be the mean. It will be the average risk. That is what we mean by that deviation. This is because all the securities, they are neither correlated with each other, okay, nor there are in any kind of a linear relationship or arithmetic term, they are any kind of way connected. That is why it is known as portfolio, okay, diversified. Okay, so Markowitz model is very important. This is what we have to study in this particular chapter. Okay, so he is the one who has come up with this theory that if you are doing a portfolio investment and you're doing portfolio analysis, we do this 2 objectives: maximizing the returns with a given calculated risk. Okay, investment strategy will focus on portfolio diversification. Okay, you have to diversify the portfolio. So now say, suppose, okay, I am, say there are, okay, sector investments. Okay, I tell you, invest your money in TCS, then in Infosys and in Wipro. I am your portfolio manager. You gave me 10 lakhs rupees and you are telling me that invest in these 3 companies. Do you think I will do that as a portfolio manager? I will say no, not at all. Why? Because all 3 part of the same group, Tata Group, also part of the same sector. So why do that? If you are interested in this particular sector, we can select one of this. We can select, say, TCS. Some amount we can select in another kind of, if you want to keep again same sector, the portfolio will never keep it. We can go into Tata Group and we can do it automobiles. Diversify your risk. So each security or each type of investment will have a risk of its own, but portfolio will have a totally adjusted risk with the diversification. Okay, now say, suppose this 10 lakhs rupees, okay, we have invested in TCS, as I told you. Okay, we have invested in TCS, and due to certain event the market has fallen down. Okay, TCS shares have fallen down by 20%. Okay, so basically how much will be your loss? 2 lakhs. 2 lakhs will be your loss. So percentage loss of your security is 20%, and your total loss of your portfolio is also 20%, because it is only one security in your portfolio. But say if same thing, I have 10 lakhs rupees, you have given me that, and I have put 1 lakh in TCS. Okay, now this has fallen by 20%. Therefore, your loss is going to be 20,000. Loss is going to be 20,000. So your percentage loss of your security will be 20%. How much will be the percentage loss of your portfolio? Other things remaining constant, other securities remaining constant. What will be your percentage loss of your portfolio? %, no? Because you have made a loss of only 20,000. Your portfolio's amount is 10 lakhs. From that, the investment in TCS was only 1 lakh. So you are understanding this Markowitz model is saying that if you are having, you need to have an efficient portfolio. Now, how will you have an efficient portfolio is that you have a diversification of the portfolio. When you diversify, so your portfolio will be less volatile. Your portfolio in an average, it will be less volatile as compared to its individual parts, okay, its individual securities. So we are here to construct an efficient and diversified portfolio. Okay, so now he has given like this. Okay, if it is similar assets, related assets, okay, in the same sector, if one will go down, even the other will go down. If there is something happening to that particular sector, travel sector had gone down at the time of COVID. Any company, if you would have invested it in, if it would have been in the similar assets, all would have gone down. But there are certain assets which are unrelated. Now, if you see during COVID, the entire stock market had crashed. Okay, capital market had totally crashed. But at the same time, you won't believe gold was rising like anything. If you all know, gold was rising like anything. So they are unrelated. You will always see whenever the market is falling, people start removing money from the market and they start putting it in a risk free, which is gold. Okay, see, gold is something where the risk is really less. Okay, the returns are also less. So even if the market is down, if you will put it in gold, the risk is already low. Though the return is low, but it is safe. Risk is really it's like zero. So when the market falls, you start removing money. Investors remove the money and start putting and investing in gold. But when the market is booming up, they start removing money from the gold because it is already touched. Gold is really high in value. You have a lot of money to remove from that and start investing in markets again. So when you keep things in your unrelated assets, when you keep your portfolio unrelated from one security to another, your return will always be there. You will always see a good, whenever I see my portfolio, in certain securities, there is always some loss. But when I see my total return of my portfolio in the statement which my manager sends me, I'm always in profit. Okay, I'm always in profit. So that is known as your portfolio analysis as per your Markowitz theory. Okay, so see this. Gold and gold, they have positive correlation. If gold will go down, if you have kept in this particular gold ETF 1, gold ETF 2 will also go down. But if you will have kept it in a lack of correlation, in negatively related securities, so then there will be a change. Okay, even if the gold will go down, then the market is going to go up. So if there is some other type of a security, it is going to rise. So efficient portfolio is what he is saying. So as per this model, okay, he is saying that portfolio is efficient only when it can yield the highest return for a particular level of risk or minimizes the risk for a particular level of expected return. So as I told you that I am asked various questions, okay, when I want to do portfolio investment, he will either ask me, first thing he will ask me how much return you want. Okay, what are you looking at? Okay, so this is like you want minimum 15% return. Okay, so he will try to make the portfolio which will have minimum risk at that my expected return. Try to diversify my money in that manner. Or he will ask me how much level of risk am I ready to take, and then at that level of risk he will try to give me maximum return. Then it may be 8% or 10% or it may be even 20%. Okay, so efficient frontier is nothing. This is known as efficient frontier. Okay, it is the set of the portfolios preparing of different portfolios and then seeing that which will give you the highest return at a given level of risk. So for doing that, okay, he does the following assumptions of the investor's behavior. First, investor is only just interested in risk and rewards. Okay, we are just considering these two things. If you are an investor, you are basically coming to me with these two important things, your risk and your reward. Okay, you at a given level of risk, you want highest returns preferred. Similarly, at a given level of return, you want the lowest risk to be taken. Okay, investors are rational and behave in a manner so as to maximize their utility within a given level of income or money. Investors have free access to fair and correct information about the return also and about the risk also. Means I am well informed, right? Investors are risk averse and try to minimize the risk and maximize the return. So this is the assumptions which he is making, and based on that he is saying that the portfolio managers make a efficient frontier and based on that they invest. So even my portfolio manager does the same thing, so I know. So see this. Risk means volatility. Okay, so now on this we have our return, expected return. So say if I tell you before this, say if I make a simple graph. Okay, this is returns and this is risk. Okay, now say suppose at this risk, okay, I have made a portfolio and portfolio A, and at the same risk there is one more portfolio which I made for you all, and here it is portfolio B. Which portfolio will you select?
B.
Obviously, because at a given risk, at this risk, okay, risk is same for A and B, but the return in B is obviously more, na? So you will of course say that select this particular portfolio. Innumerable portfolios can be made, okay, but this is the analysis which a manager does. I'm showing you that, and based on that then I select. I say okay fine, at this risk this is the highest return which I can get. Okay, so now you cannot have a C. This is the highest return at this level of risk, so obviously I will select the B one. Okay, but now say suppose the return, okay, there is a return at level C. This is the return, amount of return. Okay, there is this return of a portfolio. Also there is a return D. Okay, same return, risk is where higher. With the graph you can understand where is the risk maximum. At D, no, risk is more at D, giving the same return as C. But at C level you see the risk is less, so obviously I will select this particular portfolio over D, and I will select B over A. Am I right or not? At a given level of risk I am selecting the portfolio which is giving me the higher return, and at a given level of return I am selecting a portfolio which is having minimum risk. So this is known as the efficient frontier, which is given by Markowitz. Okay, he is saying that whichever portfolio you are selecting, select it which is closest to that frontier line. Okay, select it which is closest to that frontier line. Now see this. This particular line, this line, it is representing the efficient frontier. Okay, the optimal combination of risk and return. Below it is written, each dot represents a portfolio. The dots that are closest to the efficient frontier line are the portfolios that are expected to show the best performance with the smallest risk. Okay, so now say this is the risk here, okay, and this is the return. At the same level of risk, if you see, I will go closest to the, so I will try to select this particular return. Okay, now say this return, if I want to see, this is the amount of return, this will be the risk. So you see this particular dot, at this level of risk there is this return A, there is a return B. Obviously I will select B. This is what a efficient frontier line talks about. Understood? You all have a doubt? Any doubt? Say even in this particular risk, I will select this, no, which is closer to the frontier line, because risk is remaining the same here as well as here. It is remaining the same, but the return is more. So say C and this is D. So D is giving me more return. Same thing. This is the frontier line. Same. I've given it in another form of chart. Same thing. Nothing more. Okay. Now see the next. However, there are certain limitations of this particular model. Okay, now this particular calculation of efficient portfolio is only when your number of securities, different type of securities which you are investing are 2, 3, maximum I will say 5. Okay, but if you are an investor who wants to have like so many securities in your portfolio, then it is not possible to do this particular analysis in this manner. The number of securities, if you will keep on increasing your securities, now I'm going on, you know, I have kept on buying lot of shares in ITC. Okay, so now in ITC what is happening is, first I had started with, you know, like 500 shares. Now I'm going on buying securities in this particular, I'm going on buying shares in ITC again and again. So my portfolio is changing now. I have a portfolio, I have ITC, then I have Infosys, then I have TCS, then I also have Godrej, okay, I have Navneet, I have ONGC, I have Reliance. Okay, so this is my portfolio. Okay, this is actually what I do. Okay, so this is my entire portfolio. Now what am I doing is, over this period of time I bought shares in Godrej, okay, and I'm buying shares in my ITC. So my portfolio is totally changing. Number of securities increase, then again this frontier line cannot be made, and the portfolio manager cannot keep on looking at, okay, now, you know, this is going to be the closest return. He had made a portfolio, given it to me, now I am keeping on investing in this. So if the securities will change number, obviously this particular theory will not, this model will not be of any use, right? Further, in the real world, portfolio analysts do not keep a track of correlation between stock of diverse industries. Who knows that? There is no actual track keeping correlationship of diversified industries. Not necessary, you know, that if this particular industry is going to go down, a particular sector is going to go down, say real estate, so infrastructure is going to rise or software is going to rise. So that correlation is not really practically possible every time. Okay, so these are the limitations of the model. Now capital asset pricing model, we have already done this capital asset pricing model. Okay, so capital asset pricing model. Now this was developed by, obviously we know that, William F. Sharpe. What did he say? William F. Sharpe, John Linter and Jan Mawson, they have established a linear relationship. Linear relationship in the means what? That each security, okay, when you go from a risk-free security and you try to invest your money in market, okay, so there is a market premium. There is a market premium return. Now that market premium is, obviously you are ready to take that particular risk, which is beta, which is that market risk. Okay, So beta is of non-diversifiable risk which exists. How much ever portfolio you will diversify, that risk is going to stay, okay, upon the risk of your market portfolio, right? So CAPM model is which is trying to adjust your market premium, that additional amount, okay, from 6% you're trying to go and invest money so that you can get 16%. So for this additional 10%, whatever is the market risk, the beta, okay, you're ready to take that for this particular 10%. So that is your CAPM model. Okay, CAPM we have done before also, so I am not going in detail. Now security market line. Okay, now there are two things. Now we will study security market line and capital market line. Okay, now what is a security market line? If a portfolio is diversified properly, means you have already tried to understand the risk and adjust it. So your non-systematic risk becomes zero. There are two risks. One is beta, which is your systematic. Okay, and then one we have non-systematic, which can be controlled by the companies. Okay, so if you are telling me that it is an efficient portfolio, a well diversified portfolio, that means that the non-systematic risk has become zero and the only relevant risk is now measured by beta, right? So since we assume that the investors are concerned only with the expected return and risk, which risk are we taking care of? That is the beta. Okay, we are considering beta. So see this. Beta of the market is always 1. So this is beta. This is risk free. So when the risk is 0, say your return is 6%. When you move up, okay, you go to the market, you want higher return. Say now you want 16%. So obviously your beta, which is 1. So this is your market premium, additional 10%. So as in how and when you keep moving forward, okay, the more the return you want, there will be more risk. So this will be your security market line. If your portfolio is efficient and it is well diversified, okay, higher expected return adjusted with the beta. You all don't have to worry about the formulas given in any of the theories, okay, because we have already done it in our manner, in the way we have solved in our sums. You all have to understand only the theory, which is important. Okay, so this is your security market line. RM minus RF is your market premium. So we have done this formula. So in different manner they keep showing. So the higher the beta for any security, obviously you will want higher return, expected return. Okay, so the relationship between your risk and your return is linear. Higher the risk, higher the return. This is your security market line. Okay, now your capital market line. Now, okay, so now security market line and now capital market line. Now this is again by this Markowitz model. Okay, he is modified by introducing the analysis, the concept of risk-free asset. Okay, so capital asset pricing model, which we actually are doing. It is your capital market line, which now they are showing. Now capital market line, what does it do? It reflects the expected return of a portfolio consisting all the possible proportions between market portfolio and the risk-free asset. So capital market line does not see only one security. It sees the risk of the portfolio. A market portfolio is completely diversified. If it will carry then only systematic risk, its expected return is equal to be expected market return as a whole. So one and the same thing, when you actually analyze security market line, capital market line also becomes the same thing, because if it is a well diversified portfolio, your unsystematic risk you have already mitigated. So you are only considered with your beta. So the higher the beta, okay, this is the risk-free rate of return. Higher your beta, you see higher the return. So now even if I'll make this same particular diagram can be made, which was there in the security market line. Okay, so capital market line provides the best risk and return trade-off for an investor for the entire portfolio, okay, of the portfolio. So the feature is portfolio is assumed to be efficient, that is exact replication of market portfolio in terms of risk and rewards. Okay, so capital market line and security market line, we'll see the difference. So capital market line uses standard deviation, the risk, total risk across the x-axis of the entire portfolio kept together. Security market line uses only the systematic risk, that is the beta. Okay, that is the part of the total risk which is common to the whole market. Beta is going to affect the whole market. Nature of the portfolio, it uses only efficient portfolio. Why efficient portfolio? Because only then here also we will be taking beta only into consideration, because for us unsystematic risk is 0. Security market line uses both efficient as well as non-efficient portfolios. Every point on capital market line is a combination of a risk-free rate of return and market return, and it graphs all the portfolios and securities which lie on and off the capital market line. So it is the same graph. Security market line considers the beta, okay, the systematic risk only. However, your capital market line considers both the total risk of your entire portfolio. But since your CML model is given by our Markowitz model, okay, so it is based on that model, wherein he is saying we are always having efficient portfolios, due to which what happens, even on the capital market line we are actually taking only beta, because we have already mitigated our unsystematic risk. Alright, therefore this both actually comes to the same thing. Okay, they measure the risk free and the market risk together. Now arbitrage pricing method. Okay, first I will tell you now what happens. Now see, whenever I am talking about capital asset pricing model, first thing, this is an alternative. Arbitrage pricing theory is an alternative to capital asset pricing model. There are capital asset pricing model, it has certain types of drawbacks, okay, which is criticized by the arbitrage pricing theory. What happens in capital asset pricing model, what we are doing is we are saying that only a single number, a securities beta, we are analyzing only one single factor, beta, but once only we take beta. No, in capital asset pricing model what do? RF plus, we adjust that beta directly, bus RM minus RF, only one beta, single factor. But arbitrage price theory says that there are several factors, systematic again in nature, which affect the securities return. Okay, it is systematic and it affects the security return. It is not only one beta factor. Okay, so now if you see this formula, expected return is RF plus beta say of factor 1 plus beta of factor 2 plus beta of factor 3, 4, whatever, how many ever number of factors, because there are certain factors which are external, which are belonging to macroeconomics. Okay, so like inflation, then your GDP, your interest rate changes, changes in the law, etc. So there are a lot of factors which have a different beta. You can just not see the market's beta. Okay, and because market's beta is what? It is benchmarked with Nifty, that you compare it with whatever security you have invested in, whichever company or whichever sector, and then you apply that beta. But apart from that, there are many other external factors which are also there. So it is a multiple factor theory where you should consider the beta of all these factors also. Yield curve changes, changes in the interest rate, all those betas are also to be considered, and then multiply that by the risk premium. Okay, RM minus RF. This is your risk premium. So just do not take only one beta. Consider the beta of all the other factors, right? So that is your particularly there. This is known as a risk trade-off. So risk adjusted measure of performance. Okay, so risk adjusted measure of performance is basically, now in the current scenario, this has become very, very important. Okay, risk adjusted performance measures are an important tool for investment decisions. Whenever an investor wants to evaluate the performance of an investment, he will not be interested with the return only, but he wants to know adjusted return, that is the risk when he has to be taken to realize the profit. Okay, so for that basically we do the Sharpe ratio. Okay, Sharpe ratio is nothing but risk return trade-off. Okay, so basically the ratio says that if you are ready to, your portfolio risk and your risk-free rate of return, okay, the returns which you are going to get with your portfolio and the returns you are going to get with the risk-free rate of return, whatever, with the standard deviation of your portfolio, return risk of your portfolio. See, we will do one example. This is a Sharpe ratio. Sharpe ratio is the risk adjusted measure of the return. It is used for evaluating the risk adjusted return for an investor, which is very important nowadays. Now see, this example will solve everything. A portfolio manager has invested in blue chip funds. It is giving 19% return and the deviation, the risk standard deviation is 3.5%. Calculate the Sharpe ratio. Sharpe ratio means risk return trade-off. We have to calculate that. Okay, risk return trade-off. So basically say risk of the portfolio and this is the risk free rate of return. Okay, what they have given me, risk free rate of return is 7% and the portfolio is 19. Okay, the beta, the risk or the standard deviation of risk free will always be 0. For this they have given me 3.5%. So basically what is happening, how much extra I am going to earn from risk free, I am trying to take the from the risk free rate of return. Now I am going to get a return on portfolio which is 19. So how much am I going to get? 19 minus 7 extra. But for that I am moving and I am ready to take from 0 risk, I am ready to take a risk of 3.5. Okay, so it is known as a return risk or risk return trade-off. So if you see this, if you will do 12 divided by 3.5, you will get 3.42%. Okay, so Sharpe ratio. Okay, the investors are now interested in this particular ratio. So the Sharpe ratio for the blue chip fund is 3.42%. Risk return trade-off is 3.42%. And they have also told me that return on Sensex, return on the market, is 18% with a standard deviation where its standard deviation is 4%. So if I want to calculate the Sharpe ratio for that, if I want to invest my money in the Sensex, return on Sensex is 18. So from 7 I am going to 18. So 18 minus 7 divided by the standard deviation. So since Sharpe ratio of blue chip fund is higher, hence the fund has outperformed the market. You see the return here is higher than the return in the market. Alright. So now if you all will read this, the examples have been given again. Okay. So this is it with your theory of your portfolio management also. Anything else you all want me, you have any question you all want to ask? So what all is important is your Markowitz model. Okay, your efficient frontier line, which is important. Sharpe ratio is important from this particular chapter. All the important topics I have taken it and covered it. Okay. So we are done with this particular lesson. Thank you everyone.